Good morning, hunters, and welcome back to the Daily Hunt for Multibaggers on this Wednesday, December 3rd, 2025. We've been sifting through a mountain of data from yesterday, December 2nd, and let me tell you, it's been quite the ride.
Indeed, Ethan. We saw a significant increase in user discussions and flagged posts yesterday. Many different stocks caught the community's eye, spanning from established tech giants to some truly speculative plays. The overall market sentiment seems, let's just say it's a mix of bold optimism and deep skepticism.
A perfect playground for our hunt, wouldn't you say, Brooke? Let's dive right in. All right, first up, we've got Astera Labs, ALAB. The chatter around this one is driven by a pretty bold 140K YOLO play, with the investor betting big on the AI pump and the company's potential to be the next NVIDIA of the 2030s. There's news of product expansion and a strong historical upward trend, which, paints a very optimistic picture for growth in the AI infrastructure space.
That's all very exciting, Ethan, but when I look at the numbers for ALA, my risk radar starts flashing. That price-to-earnings ratio is an eye-watering 134.85, which means a huge amount of future growth is already priced in. And the debt-to-equity ratio at 2.463 is relatively high. What's more concerning is the net insider selling of almost 7% of shares over the last 6 months. While some news talk about strong insider backing, the actual trading data tells a different story. And that 3.9% revenue growth seems a bit modest for such a high valuation, doesn't it?
Good points, Brooke. Good points. It does seem like a high conviction bet on future potential, given we've never rated ALA before.
My AI-generated insights lean towards caution. The current KPIs, especially that PE and insider selling, make it too risky for a general buy, despite the AI narrative.
All right then, for Astera Labs, our final verdict is to stay away for now. Next up, the AI titan itself, NVIDIA, NVDA. The community sentiment is overwhelmingly bullish, calling it the sole seller of AI computing power, with strategic investments everywhere. We're talking about a company that's accelerating the AI infrastructure computing power race. Their Q3 data center sales were up 56%, and it's being called a multi-millionaire maker. They were a buy yesterday, too.
Ethan, there's no denying NVIDIA's incredible performance. The 62.5% revenue growth, 53% net profit margin, and over 100% return on equity are absolutely stellar. These numbers are hard to argue with, even for a KPI hawk like me. Yes, the PE and PB ratios are very high, suggesting a rich valuation, and the debt-to-equity ratio is 9.102, which is something to keep an eye on, but their profitability seems to indicate they can manage that debt. The minor insider selling of only 0.62% is barely a blip against the overall positives.
So you're not seeing a red flag on the horizon with that valuation, given the continued growth and dominance?
Well, the market is pricing in aggressive future growth, but NVIDIA's consistent delivery and strategic expansion, as the news highlights, could very well justify it. Their ability to turn revenue into massive profit is undeniable.
Agreed. For NVIDIA, NVDA, we're sticking with a buy, upgrading from yesterday's buy rating and continuing its strong trend. Now let's talk about Alphabet, GOOG. While the posts we analyzed were about Snap, our internal AI commentary on Google is very positive. We're looking at robust revenue growth of 15.9%, high profit margins, and Jim Cramer even thinks Gemini 3 is outpacing OpenAI. And get this, Warren Buffett bought Alphabet. Plus, there's significant insider buying. It was a buy on Monday, and the bullish sentiment continues.
The KPIs for Alphabet are indeed strong. A net profit margin of over 32% and a return on equity of 35.5% are impressive for a company of its scale. Yes, the PE ratio is 31.16, indicating strong market expectations, but those insider purchases over 1.8 million shares signal a lot of internal confidence. The high debt-to-equity ratio of 11.424 is unusual for Alphabet, but historically, they manage their balance sheet incredibly well. The news regarding AI leadership and Buffett's endorsement further solidify its potential.
So the numbers and the market perception align on this one.
They do. The fundamental strength and strategic position are clear.
All right, for Alphabet, it's a clear buy. Moving on, Snap Inc., SNAP. The community sentiment here is overwhelmingly bearish. The initial post tried to make a bullish case for 2026, but the comments are brutal. Worst management ever, dilution scam, and a clown company. We actually had a buy rating for them briefly on November 6th, but the mood has shifted dramatically.
Ethan, the numbers really back up the bearish user sentiment on Snap. We're looking at consistently negative profit margins and earnings per share. Their debt-to-equity ratio is an astronomical 186.48, which for an unprofitable company is a massive red flag. Returns on equity and assets are both negative, and the stock is trading near its 52-week low. Honestly, the only positive KPI I see is a tiny bit of insider buying, but it's dwarfed by the overall financial distress.
The news we have for Snap is completely irrelevant to the actual company.
So despite any long-term potential hopes, the short to medium-term outlook is, well, grim.
It's extremely speculative. There's no clear path to sustainable profitability with those financials. For Snap Inc., the verdict is a firm stay away. That's a downgrade from our brief buy in November. Let's turn our attention to CrowdStrike, CRWD. The user sentiment here is pretty limited here, with only one skeptical comment questioning their fiscal year 2025 performance. But looking at the news, they topped Q3 earnings and revenue estimates for fiscal year 2026, and analysts are optimistic, with KeyBank calling them an agent SoC leader in AI security. This one has never been on our radar before, so it's a fresh look.
Ethan, while the revenue growth at 21.3% is certainly strong, the company is currently unprofitable. Net profit margin is negative, EPS is negative, and so are return on equity and operating margin. This suggests they're spending heavily to fuel that growth, which isn't sustainable without a clear path to profitability. Furthermore, the price-to-book ratio is incredibly high at 34.48, meaning a lot of future success is already baked into the valuation. And we see net insider selling, which gives me pause.
So the growth is there, but the profits aren't quite following yet. The market is pricing in a lot of future success.
Exactly. For a stock with this high a valuation, I need to see more than just strong revenue growth. I need to see those losses narrowing significantly, or better yet, turning into solid profits. Until then, the risk is too high.
For CrowdStrike, CRWD, our AI-generated insight is to stay away. Now for Carvana, CVNA. This one is generating some intense debate. User sentiment is overwhelmingly bearish, with allegations of massive fraud and the company being a scam. Many users believe it defies all logic. But on the other hand, some analysts like Wedgebush and UBS have upgraded it to a buy recently, and there's talk of S&P 500 inclusion. This is a first-time rating for us, too. Ethan, the user sentiment here is a huge red flag, and the KPIs reinforce those concerns. The debt-to-equity ratio is an astonishing 192.409, signaling extreme financial leverage. That PE ratio of 85.49 and PB of 23.76 are simply not justified by a net profit margin of just 3.44%. The most damning evidence, though, is the massive insider selling. Over 28% of total insider shares sold in the last 6 months. That directly supports user concerns about executives bailing out. Professional analyst upgrades are certainly a counterpoint, but the deep-seated issues and insider behavior make this incredibly risky.
So, despite the analyst optimism, the internal data and community warnings are too strong to ignore.
Absolutely. The risks far outweigh any speculative upside, particularly given the financial leverage and insider activity.
For Carvana, CVNA, the verdict is to stay away.
Let's turn to Meta platforms. Meta. The user sentiment is quite bullish, viewing Meta as a dominant competitor with superior monetization, especially in the AI space. There's talk of their AI spending spree and significant capex for 2026, indicating strategic long-term investments. This was a cautious buy rating for us on Monday.
Meta's KPIs are robust, Ethan. We're seeing strong revenue growth at 26.2% and impressive profit margins, with net profit margin over 30%. Their EPS is a solid $22.84. But what really stands out to me is the incredible insider buying. Over 136% net shares purchased by insiders in the last 6 months. That's a huge vote of confidence. The increased capital expenditures for AI are strategic investments that, if successful, could drive even further growth and profitability down the line, validating the current strong performance.
So, the big investments for the future, coupled with current strong financials and insider confidence, make this a compelling story.
Indeed, the fundamentals are strong and the leadership clearly believes in the future direction.
From Meta Platforms CMTA, we are upgrading our rating to a buy. Next, we have IREN Limited, IREN. This stock has seen some serious community debate. While there's an original post with a 140K YOLO bet, the prevailing sentiment is very bearish due to concerns about share dilution and a predicted market correction. We've had it as a stay away most recently in mid-November.
And the KPIs, Ethan, sadly reinforce that bearish sentiment. The debt-to-equity ratio is very high at 33.574, and they've just announced a $2 billion convertible notes offering along with proposed ordinary share sales, which has already caused the stock to plummet. This indicates significant dilution for existing shareholders. Their net profit margin is extremely thin at 0.76%, and their operating margin is negative, suggesting profitability challenges. That high PE of 27.78, given the low profitability, seems inflated. While there's some insider buying, it's overshadowed by the financial maneuvers and high volatility with a beta of 4.22.
So, despite the AI association and a few bullish long-term analyst predictions, the immediate financial actions are creating too much uncertainty and risk.
Precisely. The dilution and debt concerns make it a very high-risk play right now.
For IREN Limited, our verdict remains stay away. Finally, let's talk about Marvell Technology, MRVL. The community sentiment is bullish, especially after recent earnings. Commenters noted a significant upward price movement, catching option sellers off guard. They've recently announced a massive $3.25 billion acquisition of Celestial AI, positioning it strongly in the AI data center space. This is a new one for our podcast.
Ethan, that acquisition of Celestial AI is a game changer and a strong indicator of future growth potential. Their revenue growth is also very impressive at 26.6%. However, we need to acknowledge that Marvell is currently unprofitable with negative net profit margins and EPS. The price-to-book ratio is high at 5.96, and it's a high beta stock, meaning it's quite volatile. While the unprofitability is a concern, the strategic move into AI, backed by strong revenue growth, suggests that the company is making aggressive investments that could significantly improve these KPIs in the future.
So, you're seeing the strategic long-term play outweighing the current unprofitability.
For growth investors with a higher risk tolerance, yes, the market seems to be reacting positively to these strategic moves, which could lead to substantial future returns if they execute well.
For Marvell Technology MRVL, our final classification is a buy. All right, Brooke, let's give our listeners the full roundup for today.
Investigate as buy.
NVIDIA, NVDA. Alphabet, GOOG. Meta Platforms, CMTA. Marvell Technology, MRVL. Investigate as cautious buy. None. Investigate as speculative gamble. Astera Labs Inc., ALAB.
And that wraps up another episode of The Daily Hunt for Multibaggers.
This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice.
Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses. The market is a wild place, and knowledge is your best asset.
Thanks for tuning in, and we'll catch you tomorrow for another Daily Hunt.